If you've ever watched that movie Trading Places, you've probably seen how crazy it can be back in the days when they traded in the pits. There was a lot of yelling and screaming and hand gestures when everyone was trying to get the price that they were waiting for. Now, the trader of today, the modern trader, they use trading charts to monitor price. But what did the pit traders use? Maybe they did look at charts before or after the session, but they had some pretty simple items to use during the trading frenzy. They had a pencil, notepads, they had stats on various products that they were interested in. And they had their eyes, their ears, and their brain. And those stats included price levels that they had an interest in, and they were waiting to see the reaction of price at those levels. But then what did they do? What if there was not a reaction? What if the price action is not what was expected? What was the price action prior to the price of interest? Well, what happens next? Now, you judge the market by the action that it takes at prices that are of interest to you. And you make a decision on which side, the buyers or the sellers, are the stronger part of the equation. This way, the market's just moving from one point to another point, and you're making a series of decisions along the way. So let's assume that you have a way to reliably work out prices which may hold some interest in the market in the future. Now, this is only part of the picture at levels because they're there to be broken. Otherwise, the markets would just be in a range all the time. So then you need to define the other aspects that we just talked about in order to work out where that balance lies. So what is the reaction of price? The market bounces hard. The market hugs the level or the area. The market breaks through and accelerates. The market seems to just ignore the level with little to no reaction at it. Is the price an important level for you? Well, number one, it's a very important price, or two, it's not a very important price. What was the price action before the level was hit? It's been ranging one way and then the other. It's been trending in one direction all day. It has already rejected a level strongly on the other side of the range. It's already tested a level on the other side of the range and struggled to move away strongly. What do prices do next? Well, just go back to the reaction of price segment here for how the market reacts to the next level. So using these simple ideas, a trader can get a better picture of what's going on and therefore what's potentially likely to happen. But interpreting the market, that's not a trading strategy by itself, but it can be used in a combination with a strategy in order to give a trader the confidence of their own convictions. So as an example, I've looked at a very simple price levels that are on this chart, and it's only the obvious swing extremes, the opposite extremes of large momentum style bars, and the prior session's higher low. I'm also noting the previous day's closing price, which is often retested, and the current session opening price, the current session high-low, would also be worth noting, but I didn't do it here on this chart because they will often be retested. So with these simple levels added, and I can tell you right now, these are not cherry-picked, we can take a look at some of the action from the early part of the day. So what's the use of this information? Well, we can see that very early in the session, the market was unsure of what to do. Several attempts to trade lower into the previous day's range and possibly towards the previous day's close, they're not that strong. But also the attempts to take out the 1451.5 level wasn't very strong either. Then the market resolved this by breaking higher with some strength, possibly validating the higher open. Now, in the face of the quickly rising market, sellers only just about overcame buyers at the 1457 level, with it pushing slightly higher to 1457.75. They managed to overcome the buyers, and now this is important to note. So the market drifts lower to retest the 5150 level, which did not hold as the test of the opening price was more important. And this held. Again, it's more potential for validation of higher openings, and it moved reasonably quickly up from it. So breaking this down, we can see that the low, which tested the previous day's high, was not rejected with a whole lot of conviction. And if it were to be retested, it could be susceptible, and a move towards the close is possible. Now, the high was made on strongish buying, and the sellers had a bit to do to reverse the market from there. The strong move up and the retest and the failure of the open suggests that the higher open was valid, and so there's a chance the highs will be retested at some point. So given that sellers had to work to hold it in the first time around, any break higher could see a decent continuation of price. And it's also important to be aware that important economic news can bring in additional activity and significantly alter the current balance of trading activity. So recognizing how the market moves is important in order to gain that really important context and give yourself and your strategy a greater chance of success. When the market moves to extremes, decisions are made, and depending on the way the market moves, what's likely to happen next might just become a little bit more clearer. The simple explanation is usually the best, and trying to read too much into price moves can cause analysis paralysis, so just keep it simple.